Published 0713 EDT, the 5th of September 2017. Updated 0727 EDT, the 5th of September 2017. Do you prefer to put your trust in an investing star to grow your savings, or think a team-based effort will bring better results? The people responsible for making the investing calls determine whether the funds you hold soar or crash in value. So, it's worth considering how they go about taking the all-important decisions on buying and selling, and whether their management approach seems sound, as well doing your other research before parting with any cash. Shining bright. Do you put your trust in an investing star to grow your savings? As the shine has come off even a venerated fund manager like Neil Woodford in recent weeks, we investigate whether having a big boss calling the shots really pays off for investors, or whether half a dozen heads might be better than one. Fidelity's Tom Stevenson, an expert on behavioral investing as well as fund performance, explains the pros and cons of both approaches. Since investing stars tend to be good at self-promotion, while team-old funds operate far more under the radar, we've also taken an in-depth look at a couple of investment houses that favor getting people together to combine their talents. Investing stars' rare mix of conviction and flexibility is needed. We think that probably the individual manager approach is riskier, but the potential upside is higher in terms of performance, says Tom Stevenson, investment director for personal investing at Fidelity International. There are some successful individual managers, but they are probably very rare. The exceptional fund managers are a quite unusual combination of conviction and flexibility, and not a lot of people have that. He says Fidelity is broadly agnostic on whether the individual or team approach works best, adding, "I think there are lots of different ways to manage money and no wrong or right way to do it. What are the advantages? One manager is fully accountable for successes and failures. Investment moves can be made fast. Investors tend to engage more with a single manager pursuing their own strategy. What are the downsides? Behavioral biases, like overconfidence and overtrading, are magnified when an individual is in control. Lone managers can be less inclined to change their mind or admit mistakes, but when it comes to the advantages of putting your faith in a star manager, Stevenson says there is more accountability for investment decisions because there is no one else to blame. There is also the speed with which investments can be made. The flip side of this is a disadvantage of a team-based approach. Things can take too long to be discussed and decided on. Timing is very important. You can make the right decision, but with the wrong timing, if you leave it too late, it's as bad as making the wrong decision often. Stevenson believes that having a star manager at the helm of a fund certainly helps firms to market them to investors and attract their cash. People look at other individuals and they respond to other individuals. It's difficult to respond emotionally to a team or a company. It's easier to engage with a single manager. People do tend to follow star managers. It's emotional. You are putting your money in someone else's hands, so there is an element of trust involved there. However, when star managers get so popular that their funds swell to a massive size, then can create problems. Read more here about whether giant funds can stay winners. Stevenson explains it's potentially counterproductive. It's self-limiting to an extent. It's much easier for a fund manager to produce outstanding performance with a smaller amount of money. It's why a fund will close itself to new investment. You question why a fund manager would turn money away, but it interferes with the efficient running of the fund. Behavioral investing looks at the ways people risking their money often fall into psychological traps. Understanding these can offer insight into whether your investment judgment is sound or if you are just making excuses to yourself for irrational decisions. Read our guide here. As for other possible downsides of following star managers, Stevenson says the danger with an individual is that one person can be quite prone to a number of behavioral biases that we all know about. They are magnified when it is one person. A fund is more vulnerable to overconfidence, high turnover. We might want a bit of humility in fund managers. It's a very positive and useful trait in a fund manager. It doesn't always go with the territory. It's being aware of what can go wrong with your decisions and being prepared to change your mind. It's a balanced conviction in your beliefs and having flexibility of mind. It's a rare combination. Team players. Optimum size for a team is no more than 5. The question that's worth asking is, what is the purpose of the team? What is it for? There are some jobs that don't need a whole team. They can cause confusion and dilute effectiveness, says Stevenson. It's not always easy to work out team dynamics from the outside when you are researching a fund. But what you need to try to discern from any information available is whether the balance is right between the strength and stability of the group and any tendency to develop groupthink, suggests Stevenson. What are the advantages? Greater diversity of views, people and talent. Ideas are always subject to the scrutiny of the group. Teams have the manpower to cover a wider area and specialize in more depth. What are the downsides? Investment decisions are made more slowly. Strategy can become less focused. Group dynamic can go wrong. He thinks another danger is that everyone on a team starts to follow the most valuable member, who will then dominate it. The optimum size for a team is no more than 5 people. If you have more than that, it is prone to freeloading. Not all members of the team have to really contribute. They can always blame things on the consensus, and this reduces accountability. Stevenson also believes it is a strength to have diversity in a team, not only in terms of including women and people from ethnic minorities, but in looking for differences in cognition, education and ways of thinking about the world. How do you approach investing as a team? It is simple enough to grasp that a star manager is in charge and their strategy is what drives how the fund is invested, but since it's less widely understood how team-based investing works, partly because by their nature such funds don't always have one person out front explaining how it's done, we spoke to 2 firms specializing in this kind of operation to find out more. Bailey Gifford votes, vetoes and override powers. Fund house Bailey Gifford has star names heading up some of its funds, but behind the scenes many tend to be either co-managed or backed up by large and influential management teams. The Edinburgh-based asset manager is a 108-year-old partnership, meaning it is not beholden to shareholders and doesn't have to follow fund management conventions prevailing elsewhere in the industry. Team players. Some fund houses prefer to get people to combine their investing talents. It recruits graduates with the offer of a career spanning 40 years at its business, meaning that from the start most of its investment managers are fully initiated in the Bailey investing principles: active bottom-up, value-held, long-term stock picking. James Budden, Director of Marketing and Distribution, says everyday management varies from fund to fund, but having more than one manager is common and some are run by 4 people. Meanwhile, an institutional fund might be run by a group drawn from across the business and brought together to fulfill its objective. Budden explains that investment decisions are sometimes taken on a majority basis, but in other cases teams will have a veto system, which means one member has the power to reject an idea they don't like. Here's what a couple of Bailey managers say about how their team approach works in practice. Bailey Gifford Japanese Fund and Investment Trust Manager Sarah Whitley is a Bailey star after heading up its Japan Trust since 1991 and taking over its fund in 2007. She offered some insights into how she and her team go about the stock-picking process in a previous interview with This Is Money. Asked how she chose investments, Whitley said ideas were freely discussed at a large weekly meeting while decisions were made at a much smaller meeting of managers only. The big stock discussion meeting involves not just the 6-strong team covering Japan, but colleagues from other departments at Bailey's Edinburgh head office who bring suggestions and present their latest research, she explained. It's usually quite a long meeting, said Whitley. And that's a robust debate about the merits of companies that are being discussed. Everybody who's at the meeting, even if they're just visiting us, gets to give a ranking to the stocks, and we rank them by quality and by price opportunity. It's just to give an indication if people are enthusiastic or not about the company, so it's not meant to be too precise. It's AC on quality and 15 on should it be bought. We find people if they say A/B, 3/4. That goes into the Christmas dinner pot. £1. Some people like to be vague, so it subsidizes the Christmas dinner. Whitley adds, we don't spend a lot of time looking at the C5 stocks because that isn't particularly helpful or interesting. So probably, the things we would discuss would be above average quality anyway. And it's not meant to be a hard and fast thing, but it does give you an indication of who liked things and who didn't at the end of every meeting, and we keep a record of that, and look back. Today's star investment managers spring to mind easily, as Neil Woodford and Terry Smith dominate the headlines and fund bestseller lists. One well-known team-run fund is Standard Life Global Absolute Return Strategies. It has a management team running dozens of different investment strategies at once. It's a fund that's arguably unmanageable by one person. Instead, it offers an umbrella for many managers to pursue varying strategies. From investors' point of view, this diversity also means the risk should be diffused. Bailey Gifford European. The fund has a named manager, Thomas Coates, but he has several co-managers including Moritz Sitt, who describes how they operate together as a team. Sitt says an investing idea will always be taken up if one co-manager backs it, even if all the rest are opposed. The aim of giving one person override power if they feel strongly enough is to avoid consensus decision-making and falling into groupthink traps. However, the amount of stock bought as a result of this process is proportionate to how many managers were in favor, so if only one manager supported buying a stock, a smaller position will be taken than if all of them did, he explains. Seneca Investment Managers. All investing ideas are scrutinized by whole team. Liverpool-based Seneca specializes in multi-asset value investing, and its 5 managers run 2 funds and an investment trust between them. Chief Executive David Thomas says a couple of years ago the firm decided to change the way it did business in 2 ways, and that this has led to an improvement in performance. First, it decided to become much more explicitly value-oriented. That basically means picking unloved stocks or other assets with turnaround potential. Second, instead of having any named managers in charge of its funds, everyone would specialize. That means they would each look at one area in depth, but in ways that complement each other, and still with one chief investment officer retaining oversight. Ideas are subject to scrutiny by the team, says Thomas. Does the idea have genuine value? Has enough detailed work been done? If taken up, an idea is then implemented across the firm's portfolio, although asset allocations will be different in each fund. Thomas adds, I am not saying this is right for everyone. It's right for us. Seneca Global Income Growth Trust seeks to achieve a total return of at least CPI plus 6% a year after costs, with low volatility, and the aim of growing aggregate annual dividends at least in line with inflation. Seneca Diversified Income aims to generate a high level of income and maintain the real value of capital over the long term. Seneca Diversified Growth aims to generate long-term capital growth by investing in a multi-asset portfolio, managed with a focus on value.